70%. That's how much of Berkshire Hathaway's entire $334 billion portfolio is sitting in just 5 stocks. And Warren Buffett, the same man running that concentrated bet, just publicly warned that retail investors are gambling. Now Jim Cramer is firing back. And the timing couldn't be more dangerous. Here's what's really going on. And what you should be thinking about right now. Because one of these men is right. And depending on which one, your entire allocation strategy needs to change today. Buffett's warning wasn't vague. At the 2025 Berkshire annual meeting, he told a room full of shareholders that America has developed a gambling culture around markets. Retail investors treating stocks like casino chips. Cramer hit back fast his argument? Retail investors aren't addicted to gambling. They're addicted to the S&P 500. Passive index investing. The boring trade. He's saying that's not a vice. That's discipline. But here's the number that stops you cold. The S&P 500 is now 32% concentrated in its top 10 holdings. The highest concentration level in over 40 years. Apple alone, Berkshire's single largest position, represents roughly $174 billion of their portfolio. That's one stock, one company, one risk. Meanwhile, geopolitical shock just hit the tape. Fresh US-Iran military strikes are rattling energy markets right now. Oil is repricing in real time. And Thursday's PCE inflation reading, the Federal Reserve's preferred inflation gauge, is coming in hot. That print directly impacts when the Fed cuts. And rate cuts move everything. Markets are pricing in 2 scenarios simultaneously. That's not stability. That's tension. But here's what nobody is saying about this yet. Buffett and Cramer aren't actually disagreeing. They're describing 2 different investors. Buffett is watching options traders, meme stock chasers, and leverage players blow up their accounts chasing dopamine hits. Cramer is defending the 401k holder who buys SPY every 2 weeks and doesn't touch it. The real trap? The investor who thinks they're in Cramer's camp. Passive, disciplined, but is actually in Buffett's camp without knowing it. Rotating in and out of sector ETFs. Panic selling on geopolitical headlines like today's Iran news. Calling that active management. That investor is getting the worst of both worlds. Index-level diversification with gambling-level behavior. 1. Check your actual behavior, not your holdings. If you've touched your allocation more than twice in the last 90 days, you're not a passive investor, regardless of what you own. 2. Understand what concentration risk you're actually carrying. If you hold SPY, QQQ, and individual mega-cap tech, you own Apple 3 times over. That's not diversification. 3. Watch Thursday's PCE print before making any moves. A hot number pressures rate cut expectations. Which hits growth stocks hardest? Exactly where S&P 500 concentration is highest right now. Buffett runs a 70% concentrated portfolio and calls retail gambling culture dangerous. Cramer defends passive index investing as the disciplined choice. But the S&P 500 is now more concentrated than at any point in 4 decades. Agree or disagree? Passive investing has quietly become the new speculation. This video is for educational purposes only, not financial advice. Always consult a qualified advisor.